Stock markets tumbled and Japanese shares plummeted a gut-wrenching 13% as fears the U.S. could be heading for a recession sent investors rushing from risk while wagering that rapid-fire rate cuts will be needed to rescue growth. The safe haven yen and the Swiss franc surged as crowded carry trades unraveled, while a torrent of selling triggered circuit breakers in some exchanges across Asia. Japan's Nikkei shared 13% to hit 7-month lows, marking the biggest three-session low since the 2011 financial crisis. Japan's Nikkei at the same time, while we did see those losses being the highest since those 2011 financial crisis, we did see the Hong Kong Hang Seng Index also down 1.6% as of the final hour of trade, while mainland China fell 1.2%, seeing the smallest losses in Asia. Meanwhile, U.S. stock futures fell following a volatile week for Wall Street in which the Nasdaq Composite dropped into correction territory. The Dow Jones futures was also a little bit lower, and we also saw negativity across the S&P 500 as well as the Nasdaq. Wall Street is coming off a brutal week for the major averages. On Friday, the Nasdaq capped a third straight week of losses, bringing the tech-heavy index down more than 10% from a record set last month. The S&P 500 also posted a third straight losing week, down 2% for the week. Even the Dow Jones Industrial Average, which had been outperforming, snapped a 4-week win streak, falling around 2%. Looking at the JSE, that's taking its cue from global markets, with the all-share index slumping almost 2% to just above 78,000 points. Looking at commodities, gold falling to $2,420 an ounce, platinum $922 an ounce, and a barrel of Brent crude oil $75.42 a barrel. The rand is currently trading at 18.63 to the dollar, 23 rand 77 to the pound, and 20 rand 39 to the euro. To help us make sense of the markets picture, we are joined by Gary Boyson, who is a portfolio manager at Rand Swiss. Gary, thank you so much for your time this afternoon. Help us make sense of what we're seeing on our screens. It's still red across the board when you look at the all-share index. Does this have to do with just the jobs report that we got on Friday, or is this a compounding effect of what we've seen over the past couple of weeks?
It's very difficult to put your finger on exactly why this is happening. So absolutely, the jobs report was a lot weaker than expected. The market was expecting 175,000 jobs to be added. We got 114,000 jobs added. Unemployment was expected to come in at 4.1%. It came in at 4.3%. Even if you look deeper into the average hourly earnings, we're expecting them to rise around 3.7%. They only rose 3.6%. So it was a miss across the board. But really, it has sent the market into a tailspin. So if we look at kind of where the futures are pricing interest rate cuts at the moment, we've got almost 100% chance that the Fed is going to cut interest rates in September by 0.5% instead of 25 basis points. But chatting to the older traders that we speak to, a lot of them saying this is feeling a little bit like Black Monday in 1987, where the real reason behind this fall is difficult to pinpoint. It doesn't feel, I mean, we've seen misses on non-farm payroll numbers before, far greater misses than this, and yet the market is just very, very spooked. And maybe it's that the underlying indices that we're looking at are just too high, that this tech bubble, this tech rally that we've seen over the last year is just starting to burst, and a lot of people just heading for the exits, very, very nervous. If I look at it, the Nasdaq, for example, which is the big tech index in the US, that's now deeper than correction territory, but down more than 10%, but it's still up 20% for the year. So it does feel like the market's just gotten a little bit too hot, and suddenly you're seeing a little bit of panic and selling, and everyone that's sitting on a lot of gains is suddenly saying, hey, cash is looking pretty good at the moment, and maybe exiting some of the positions. Now, one other figure that I'll give you, just to kind of highlight the gravity of the sell-off that we're having at the moment. If you look at something like the VIX, which is the volatility index, a lot of people call it the fear and greed index. It really is a great gauge of market sentiment. It's currently sitting at 50. Now, this typically trades around 12 to 20, in regular volatility. And the last time we were at 50, if you go pull up a chart, if you do some Googling, was in 2020 when we had the COVID crash. And before that, around these levels, before that was 2008, so kind of the midst of the global financial crisis. So the volatility that we're seeing in the system at the moment is absolutely incredible. It is really, really high. There's a lot of fear in the market at the moment. But as I said, very difficult to isolate exactly what the challenges are.
With that said, and seeing that we are seeing a lot of fear in the market and some investors are running to the safety of bonds, where are you running to, or are you doing anything at all?
It's a good question. So, what they say, if you're going to panic, panic quickly, or don't panic at all. So looking at it, I think our core positions, we're still very happy with the kind of stocks and sectors that we invest in. We don't lose any sleep through this type of market volatility. None of the positions that we hold are going to go bankrupt because their share prices are moving around a little bit. But that said, there's absolutely, whenever there's sell-offs like this, it does create a huge opportunity for investors that are sitting in cash, and because it gives you a great opportunity to deploy. Now, whether we're at the bottom yet is anyone's guess. It's a very difficult thing to pick, but I think sectors that will kind of continue to do well, if you're looking for a little bit of protection in this kind of environment, consumer staples, if we're heading into a US recession, the likes of Coca-Cola, something or even something like AB InBev on the local market, something like British American Tobacco. You're expecting interest rates to decline. These stocks have high, very, very stable dividend yields, and they kind of almost act as a proxy for bonds. So when it's a stock that behaves almost like a bond. So that's definitely somewhere that we're looking is the consumer staples and the more defensive stocks, as well as something that I've been, I suppose, chatting about a lot of investors and said on this program a couple of times is now might be the time to start looking at real estate again. You're probably going to have a falling interest rate environment. You're going to be able to get nice yields out of the property sector, and it is to an extent non-correlated to the overall stock market. So maybe time to be dabbling a little bit of real estate as well.
Not too long ago, we had the Federal Reserve, insisting that inflation was transitory and they were late to come to the rate hiking party. Now there are fears that the Fed may have been at the party for too long while other central banks have stepped out. Are you afraid that perhaps the Fed is late this time around and perhaps they should have hiked?
Well, should have cut.
Well, rather should have cut, that is. Yeah.
At least it does look that way. So remember, monetary policy is typically kind of 12 to 18 months forward looking as well. So it's very, very difficult because the Fed is looking at data that reports backwards. So when we look at the non-farm payroll figures, we're looking at the month of July. But when you're tweaking monetary policy and you're thinking about interest rates, you're going to impact the market in more than a year's time. So it is very, very difficult. And of course, they're always going to say it's very data dependent. But if I, again, look at the Fed funds futures, there have been massive moves in the last week or so, ever since obviously Jerome Powell spoke at the FOMC, and then of course with the big labor number on Friday. Now, what's happened is we're essentially pricing a 97.5% chance that we're going to get a full half, or at least a 0.5% cut. Market was really just expecting around 25 basis points, or 0.25% up to 2 weeks ago, and so that has really changed. But I suppose what's even more significant is that if we look out to the January meetings, so the next 4 Fed meetings basically, we're expecting around 1% to come out of US interest rates, and there's a 99% chance that will happen. That means at least a 0.25% cut at every meeting, or potentially 0.5% and then a pause. So the market is saying interest rates are going to come down aggressively. So the market is definitely saying the Fed has waited too long and now has to almost do some backpedaling and has to cut interest rates aggressively. In the local market, I think our Reserve Bank is probably going to follow suit. I believe the next MPC is one day after the Fed meeting. So hopefully a little bit of relief for any indebted South Africans out there.
All right, Gary, thank you so much for your time. That is Gary Boyson, who's a portfolio manager at Rand Swiss. And just a quick look at our markets. All share index still down 1.9%. And it's the financials, the resources, as well as the mid caps and small caps also taking a bit of heat there. But we're going to take a quick break. When we come back, we'll have more news. Stay tuned.